This is Unsiloed, brought to you by Alumni FM, connecting people through stories.
Hi, welcome to Unsiloed. This is Greg LeBlanc, and I'm here with Scott Kupor, who is Managing Director at A16Z, otherwise known as Andreessen Horowitz, and also the author of this amazing book, Secrets of Sandhill Road. And as I was saying to you, Scott, just before we started, when I read this book, I was like, this is like my entire course in venture capital summarized in one book. Like, I don't even need to teach. I can just hand people the book and say, read this, and skip the course altogether. Thanks for joining.
Well, thank you, Greg. Thanks for having me.
So the title of the book is Secrets of Sandhill Road. And I think one of the things that people all around the world always wonder is, why is place so important, right? I mean, people in other parts of the world come to Silicon Valley and say, we want to have a Silicon Valley in, Turkey. We want to have one in Kazakhstan. We want to have one in India. And they try to kind of recreate the special sauce. Now, I know there's, legal factors and other things, but why, even in the United States, where you have similar legal systems across different states, what is so special about place? Do you think that place is going to continue to be important, especially now that people have learned to work virtually and VCs can take pitches on Zoom and so forth? Do you think that it's going to be just sort of the secrets of venture capital going forward, or will it continue to be secrets of Sandhill Road?
Look, I hope it's the latter, which is I do hope that the next version of the book, or maybe not the next version, but the version maybe 10 years from now doesn't have Sandhill Road in it. So as you know, Greg, what's interesting about it is Sandhill Road was not venture in the first instance, right? So there was, Boston and even parts of New York were the original foundings of venture capital. I think what happened historically, and there's a great book on this by a professor out of the University of Washington. Historically, what happened was, a couple of things. Number one was just as part of kind of the military industrial complex, there were, companies out here that kind of got started, and a lot of the dollars flowed, quite frankly, in terms of basic research. There were some legal issues. So one of the big differences between, Boston in particular, which was a very big hotspot for startup activity, has to do with things like non-compete agreements and things of that sort. So stuff that makes the free flow of human labor and human capital easier. But what I'm most excited about, despite all the, unfortunate circumstances we're all dealing with in the pandemic, is we may, for the first time, finally be in a world where we have untethered geographic location and the location of your employer. Now, I'm not suggesting that, Silicon Valley or Sandhill Road is going away tomorrow, because it is a network effect that's been built up for, 70 plus years, and network effects are very strong. But, if you imagine a world, I think what we've all learned in this pandemic is that we can do things, kind of that are untethered to our office. And that may vary by job category and classification to a certain extent. But you can imagine then over a 10 or 20 year period that if companies start to hire people remotely, then if we have the right incentive structures in those local geographies, we might actually have, entrepreneurial ecosystems that can build up in other places. So, you mentioned, Greg, when we were chatting, that you've done some work with the NVCA in Berkeley around some of these startup sessions they're doing. And the whole purpose, as you know, around that is to try to kind of target geographies that have historically not had as much, kind of success from an entrepreneurship and a venture capital perspective. And so I think we're kind of putting the building, parts in place, like we're doing the education. Hopefully post-pandemic, we start to see more flexibility around geography. And then I think there's a real opportunity that we could be sitting here 10, 20 years from now and finding that, the fruits of Sandhill Road ultimately can kind of be much more readily available across lots of different geographies.
I mean, the thing about venture capital is just how hard it hits beyond its weight, so to speak, right? I mean, in the universe of assets, right, where you have fixed income and public equity and, real estate and all this, I mean, venture capital is just this tiny little, almost, insignificant blip of capital on the global radar. And yet, none of the companies that we know now of as household names, that have been formed in the last 30 years would have been conceivable really without venture capital. And yet, there are other ways that companies get started, both historically and geographically. So why is it that venture capital, just to kind of summarize the nutshell of the book really, is like, what is so special about about venture capital? Why is it so powerful on a dollar for dollar basis?
Yeah, so you're absolutely right in terms of, look, on a dollars basis, venture capital barely registers, compared to other private assets and certainly compared to public assets. I think the reason why venture capital has persisted is it fills a gap in the market that just doesn't otherwise get satisfied, which is, for many businesses, going to a bank and getting a loan obviously is a very good and a well-trodden path to getting funding. But for other things where you have long lead times, you have people really trying to kind of, take on risk that is just well beyond what a bank or other financing source can do. There's really not anything other than venture capital that can provide that, right? What's miraculous about venture capital is we've figured out how to align all the incentives, which is if I'm an entrepreneur and I want to start something that's going to require a decent amount of capital to get going, and I'm signed up to try to kind of go after a market that I think is big enough to support a big company, it turns out that the venture capitalists' incentives are exactly aligned. That's basically how we get measured and how we get, ultimately the difference between success and failure in our business is, do we find those few opportunities that kind of can become the next Facebooks, the next Googles, Airbnbs of the world? And so you've got this, in a weird way, this perfect alignment when it works well. Now, there's often times where it doesn't work well and that alignment doesn't work. But when aligned well, you have entrepreneurs who want to build something big that will take, 7-10 years and involve a very high risk capital. You've got venture capitalists who are incented the exact same way, which is the investors who give them money want to see that. And when that works, it's a beautiful, kind of tune essentially, and allows us to actually, align incentives in a way that just doesn't exist in other forms of financing. So I think venture capital plays a unique role there. But look, as we talk about in the book, sometimes if those incentives aren't properly aligned, that definitely, there are issues certainly that can come out of that as well.
So in my career, I've taught in finance, I've taught strategy, I've taught law, and I've taught organizational economics. And while venture capital seems to be or is considered a branch of finance, I find that finance is probably the least useful discipline when it comes to understanding venture capital, right? So in a traditional finance class, you learn about valuation, and you learn about probabilities assigned to different states, and then discount rates and so forth. And while those things are helpful, it seems like if you know too much finance, it might even get in the way of being a good venture capitalist. What makes venture capital different from other branches of finance, and why might someone who's like a really good kind of buyout PE type finance person, or derivatives pricing, asset pricing kind of person, why might they be incapable of being a good venture capitalist?
Yeah, I think there's a couple issues there to untangle. Number one is essentially what we are doing in venture capital is we are basically looking for things that have uncapped upside. And then we do have capped downside, obviously, because we can only lose, obviously, the money we put in. So we're looking for asymmetric opportunities. In some respects, it almost looks like, to go to your normal finance world, it looks like, out of the money call options is kind of one way to think about what we're doing. Now, the problem is, if for those of you who are fans, of course, of Black-Scholes, what do you care about if you're trying to value an option? Well, you care about time to exit and volatility, probably are the two, largest, determinants of value within an option. And that's basically what venture capital allows us to do, which is it allows us to take on significant amounts of volatility and also to have a very, very long time to exit. So that's why, at least in theory, we perceive those options have value. Now, many of them, to continue the analogy, will expire worthless, which is also kind of, I think, the other side of this business is you can't measure success based upon your percentage success or failure rate. In other words, if you invest in 10 companies and you get, 5 or 6 or 7 of them right, we don't really know, quite frankly, whether you're good as a venture capitalist. It doesn't really tell us anything. Everything here is about the magnitude of the winners. And the reason for that, I believe, is because we really don't know, given the earliness at the stage at which we're investing, it's really hard to know what will work. And so we're trying to use heuristics, right? We're trying to say, okay, if it works, is the market big enough? And therefore, could the market sustain a very, very important standalone company? And then, is this the team ultimately that can do that? And of course, if we knew the answers to those a priori, we would, of course, only invest in those winners, and we wouldn't invest in any of the ones that don't work out. But these are, by definition, human beings starting companies, which means you've got all the unpredictability of, interpersonal relationships in addition to the market that really drive things. So the fundamental way to think about our business is, kind of you could make one or two very good decisions if those decisions turn out to be uncapped upside and deliver on that. And no one really cares, as crazy as this sounds, no one cares if you got the other 8 wrong because the math can still work out in your favor. So it almost goes against everything that you would learn in finance or everything if you come from an academic environment where the goal is always to get, kind of an A on a test. Here, you might actually get a failing grade if you look at your percentage success rate, but you could get an A based upon, dollar appreciation that you realize on one or two kind of discrete investments.
Yeah, and that's sort of the real option way of thinking, which has made its way into finance. And it's a very difficult thing to convince, say, a traditional CFO to think about.
Right.
But I think it goes beyond that, right? Because even in kind of real option thinking, the distribution of the payoffs is exogenous, right? It doesn't really depend on the actions of the investor, right? So in traditional finance, the investor is sort of passive, but in all forms of private equity, especially venture capital, I mean, the role of the venture capitalist is very much as an active advisor, right, and mentor to the businesses. Could you talk a little bit about that aspect? I think that's probably the least understood aspect of venture capital. You're not just placing bets, but there's this very deep involvement with the business. And in fact, maybe talk a little bit about how Andreessen approaches this relative to some of the other venture capitalists.
Yeah, happy to do that. And let me start though with hopefully the obvious, but let me make sure it's very clear, which is you're absolutely right, which is venture capitalists take a much more active role, and that varies obviously by venture capitalists in companies than do maybe a traditional public market equity investor. But I want to be very clear at the end of the day, look, success or failure in these companies is a function of the great work that the entrepreneurs do. So, when things go well, we get to kind of ride along and celebrate alongside them. But I also don't want to overstate the role of the venture capitalists because, these are ultimately businesses that have to be run by managers who understand the day-to-day business. So the way we think about it in Andreessen Horowitz is, let me start at the macro, which is this business has become very competitive. It used to be that kind of access to capital was competitive differentiation in this market. So if I could raise a lot of money as a venture capitalist and therefore deploy that was for most of really the first 40 or 50 years of venture capital, that was sufficient way to differentiate myself in the market because capital was scarce and the venture capitalists had it. And therefore that connoted power and connoted differentiation. What's really happened over the last 20 years, and Greg, this this is not just a venture thing, but look, capital generally has become cheap all across the world, and venture capital is no different. And so therefore, capital alone no longer really differentiates folks. And so I think this has been a positive thing for the venture capital industry in that we've had to figure out, is there some other value add that we can bring to an entrepreneur that allows us to differentiate ourselves in the market? The way we've approached that at Andreessen Horowitz is we've said, look, we like backing founders who want to be CEOs of their companies. And we also believe that these are inherently product-driven companies for the most part. We invest in the, largely software-based businesses. And so in tech, product is really important because product cycles are very fast. And if you could make a product cycle and you can miss a product cycle, it could be the difference between success or failure in a company. So when we started the firm, we said, okay, if we're going to back those types of individuals, what are all the other skills they will need to learn over time that will allow them to grow into the broader CEO role? And so as an example, if you're a, product-based, technical founder, you may not know all the heads of all the buyers of all the potential customers that you want to sell to. And so our MO as Andreessen Horowitz was, if we can build those relationships and we can know the head of the FedEx procurement organization or Goldman Sachs or others, and then basically help introduce those relationships and those networks into our founders, that would enable them to effectively kind of jumpstart their sales efforts in a way that might have otherwise been difficult. And so we've kind of replicated that kind of network-based operation across different areas. Sales and business development is one, getting access to talent, whether that's executives or engineers, understanding and managing through marketing and PR activities, and then even downstream financing. So that's the way we've approached the business, is to say, okay, if we can effectively help a product-based CEO grow into that long-term role of being the full-time CEO for the company, we think that can produce fantastic outcomes, obviously, for the company and for ourselves. Now, different people have different views on it, but that's kind of what, when we say kind of, venture capitalists are intimately involved in the business, for us, it means number one is helping in terms of relationships, and then number two is we always have a board member, one of our general partners who sits on the board of the company, and hopefully, therefore, is a good coach and mentor, and also kind of organizational company builder that can really help the CEO grow into that long-term role.
So, if there ever was a time when the pitching was unilateral and you had just companies or founders going and pitching to VCs, those days are over. It seems like the VCs spend at least as much time pitching to the founders, and the founders are asking a lot of tough questions of the VCs. It's not just the VCs asking tough questions of the founders.
Yeah, I think that's exactly right. And this is, again, it's not that this didn't happen, kind of pre 2000s or so, but the nature of this has just dramatically changed. And again, I do think it's what we talked about earlier, which is, once capital no longer became scarce, rightly so, the entrepreneur said, okay, well, like, what else do I get besides capital? And how do I decide if I want to work with you or any of the other firms that are courting me? And so you're absolutely right. I think success in this business is really defined by really kind of three primary things that a successful firm has to do. Number one is, you've got to do the outbound relationship building and the sourcing of opportunities so that you're in the mix even when, great deals come up. Two, of course, is then you got to pick the right winners. So hopefully you're fishing in the right pond by having done a good job on that first part, which is to kind of, build your network and get access to opportunities. But ultimately you've got to obviously, I don't want to underestimate picking. It does matter a lot in this business. And then thirdly, which we talked about earlier, I think you have to find ways to kind of add value to the company. And sometimes that may be, you as a board member, sometimes it might be a set of relationships or networks you can introduce them to. But I think that's really become, those three have really become table stakes now for venture capitalists to be successful in this business. And look, I have no idea how to forecast exactly what the world will look like, 10, 20, 30 years from now. But I would imagine we're not going back to a world where capital becomes a massively scarce resource. And so I think this idea of venture capitalists having to really think about what it is they bring to the table is, number one, I think it's a good thing. And quite frankly, I think it's going to be an enduring thing in the industry.
Now, of course, I think it's a common phrase in Silicon Valley to say you bet on the rider and not on the horse. And so a big part of the venture capitalist's job is to identify the founders that really have what it takes. And since we're both in the education business, I teach more or less full time, and you do some teaching both at Berkeley and Stanford. Maybe you could say something about what you're looking for in a founder, right? What is, because as instructors, we want people to know how to read a term sheet. We want people to know how to do a DCF. We want people to know how to interpret a p-value. But there are these other higher level attributes that people need to have in order to be successful. And what are they in your view? What are those higher level skills, and can they be taught? Right. So a lot of VCs that I speak to, they say, I really don't like to have MBAs as my founders. They think that somehow, either the MBA filters for people that don't have it, or if the MBA kind of beats it out of them. Maybe not all MBAs. I certainly hope that our MBA doesn't do that. But what are you looking for?
Yeah, sure, Greg. So first of all, let me be totally clear. MBA or not MBA is not a filter, but I do know certainly that people have very different views about how to think about that. But here's how I would think about it is, you're absolutely right, which is, look, so much of what we do at the early stage is a team-based decision, right? Because we're doing the kind of market check to say, okay, let's assume everything goes well. Do we think a market will exist that can support a big standalone, hopefully public company at some point in time? And the reality is, look, we're kind of trying to, predict into the future. We're not often very good at that, but that's probably not a big reason for ultimately why you decide, to or not to invest in a company. What it really comes down to is, okay, let's assume that market is big and we believe our analysis there. It's really a question of kind of, we know that market will attract competition. So what is it about this team that makes them uniquely suited to be able to go after the opportunity in a way that I can't conceive of other teams that could be better suited? And we think about it in a couple ways. One is, I would call it kind of the concept of product market fit that many people have heard of, but applied to founders, which is kind of founder market fit is maybe the simple way to think about it, which is, what's the affinity between what you and your founding team have decided to do and how you came to that, right? Is it, you've studied this for the last 10 years, or you've experienced the problem, or you almost organically felt compelled to build a product to solve a problem that you had in real life, and kind of, almost starting a company was in some respects an afterthought once you actually dealt with the product issues. So we're looking for something like that, which tells us, what is the fitness between the founder in this idea, mostly because we want to kind of understand what will they uniquely bring to the resolution of this problem. So that's a big part of what we're trying to figure out. And then the second part, I would say, really goes to the fact that we know for these companies to be successful, the founding team is going to have to be able to recruit great people. They're going to have to be able to sell, in many cases, evangelically before the market exists. And they're going to have to go raise capital again. And so we think of those as, you could put those either in the bucket of kind of leadership qualities. In the book, I use this concept of storytelling, which to me is one way to think about how do you get people to follow you and potentially do irrational things like quitting their current job that pays them a nice salary in order to come join you on your journey. And so those are the intangibles that we tend to try to look for. Look, none of these are perfect heuristics for success, but what we found ultimately is if we have a good kind of understanding of the idea maze and the product cycle that the founders have gone through, and then we have some way to evaluate kind of not only their leadership skills, but I would call almost their velocity of doing work. So we've definitely found over time that kind of output per unit of time, the higher that is, that tends to be a reasonably good predictor of success for some of these companies. So we need people who have that mindset, which is we're going to kind of iterate, move quickly, make decisions, keep the train moving, and ultimately, have a compelling enough story to be able to get people to, as I said, almost do the irrational thing of joining them for a ride that could very well end up in a pretty bad spot, just given what we know the likelihood of success is for these businesses.
Well, we all know software is eating the world, and that machine learning is also eating the world, and pretty much every decision is being automated and improved with AI. But the process of identifying good prospects in the world of venture is still very much a human task. Do you see, I know there's been a lot of efforts to try to crack the code and kind of, automate the process of deal flow selection. Is there, do you have any hopes that is this kind of the final frontier of machine learning, just like, producing artworks and other kind of creative tasks?
I hope so, and I also want to make sure that I don't want us to look like we are kind of Mark Andreessen, my partner, uses this term sometimes, which is are we the last dinosaurs, basically? In other words, this is an industry, as you know, that really has not embraced AI and machine learning in terms of the deal identification or deal selection process, and it seems hard to imagine that over time there shouldn't be some signal that we ought to be able to derive from that data. I think the big challenge is so much of what we do, as I mentioned, particularly at the early stages, number one, there is no data. And so you're looking for potentially characteristics of people. And it's possible that AI could help us on that. It's also possible that it may just be that because these are basically people-driven decisions, that it still makes sense for kind of people to be involved in the process. So look, there are early efforts at this. So there are some venture firms who exclusively use kind of AI and machine learning techniques to try to kind of identify opportunities. Some of them use it more aggressively on what I'd call the upstream side, which is kind of as a way to filter through opportunities, but then they still have kind of, human intervention on the actual picking process. It feels to me like the filtering piece may be an easier one to start with. And I think, many of us will continue experiments there. On the actual decision-making process, as I said, at the risk of potentially being the last dinosaur, I think the jury is still out. But it just seems almost inevitable that if software is eating the world, at some point it will eat venture capital. And I guess the question will be: is that in my professional lifetime, or maybe in the professional lifetime of your students?
So we all know that as a founder, you need to understand your customer, and the earlier you can kind of get a handle on what your customer wants, the earlier you'll be able to develop a viable business model. But I always like to say that the people who are investing in your company, they're customers as well, right? They're people that, are effectively buying your product, buying your ideas. And so you need to kind of get out of the building and go talk to them as quickly as possible. Is it ever too early to start talking to investors? I mean, even if you're thinking pre-seed, should you be going and talking to your potential Series A investors to kind of find out what they're going to want to see downstream?
I don't think so at all. And I apologize, Greg, you cut out a little bit, but I think I got the question. I don't think there's any harm in talking to investors too early. And in fact, actually, a big piece of advice that we give founders when they raise capital is you always want to be thinking about what is the story and what's the company going to look like at the next round of financing, and then almost back into your current financing based upon what you think the next round will look like. In other words, how do I know how much money to raise today? Well, the answer is, what's the right amount of money that de-risks the opportunity sufficiently so that I can then go raise additional capital when I hit to that next milestone. So I don't think there's ever any harm in doing so. The harm, of course, as you know, always with talking to any kind of customer, whether it's your actual end user customers or whether you consider venture capital as a customer, is making sure that you don't over-interpret or over-conclude from that information, because often people in any walk of life, people have no idea what they actually want sometimes, and until they actually see it. Nobody told Steve Jobs, kind of that they needed the iPhone, for example. Mm-hmm. And so the only danger, I think, of kind of being super early in any of these things is just that you can get a lot of false signals. And so I think that's not a reason not to do it. I just think you have to be very clear that many times people actually don't know, in many cases, what they're looking for, whether that's on the investor or on the customer side. But what really does work from a product development perspective is just constant iteration, right? I mean, everybody talks about, of course, lean startup and all these other wonderful things, and they're all very important. But what they really amount to is this basic fundamental idea that until you put a product in somebody's hand and allow him or her to actually play around with it, it's really hard to assume that any of the kind of preconceived notions you have about the market are in fact correct. And you may get it right, and that's wonderful, but I think the likelihood is that you will probably get it wrong. And so the sooner you can get something into market in any respect that allows you to start iterating and getting feedback, I think the better off you are in all cases.
Now, you might think that this book is really targeting venture capitalists or aspiring venture capitalists, but I think it's just as interesting to entrepreneurs. Perhaps entrepreneurs make up the bulk of your buyers, I would imagine. I think at the programs that we did at Berkeley, we had more entrepreneurs than venture capitalists show up for the sessions. I think you might be. Can you hear me? One of the most useful tips that I saw in the book was related to putting
Greg,
together.
I don't know if you can hear me.
Yeah, one of the most useful tips that I saw in the book related to putting together a pitch deck was making sure that you identify, what are the milestones that you expect to achieve in terms of information acquisition before your next funding round. Right. So I like to think of the CEO as the chief experiment officer, and every pitch is really a plea for more funds to run some more experiments. Is that sort of how you guys see it?
Yeah. Yeah. Hey, Greg, and I apologize. You cut out a little bit. So I think we were talking about putting together the pitch book.
And specifying what you expect what milestones.
Is that what you were trying to get to?
Yeah, in terms of information acquisition you expect to achieve before the next funding round.
Yeah. So, it's a little bit related, I think, if I heard the question, to what we talked about before, which is think about from the venture capitalist perspective that you're talking to today. What are they worried about? Well, they're worried about a couple things. Number one is they might pick the wrong company to back, right? So it may be too early in the market, and therefore they may be right on the market and wrong on which company to back. And then the second thing they're worried about is, am I the only person in the world who's going to believe this is a good opportunity, and there's going to be a lot of downstream funding requirements for this business, and will other investors potentially come in and follow me if I put money in as a way to help validate that? And so I think the way to think about de-risking both of those issues is exactly what, kind of I think you were mentioning, is think about today, if you're raising your seed round, what is the A round story going to look like? And if you fast forward to that, is that going to be compelling to somebody at the A round? And therefore, that helps inform my thinking when I'm looking at this on the seed round. Jeff Bezos famously, and And actually, there's a book that just came out called Working Backwards, used to do this in terms of how they thought about product development, right? Which was the first step in product development for Amazon was what is the press release going to look like when we announce this thing, and then work backwards from there to effectively figure out, therefore, what are the product development requirements associated with getting to that ultimately final form of a press release.
PRFAQ thing.
Exactly right. Yeah, and I think in many respects, maybe this is just the analog of it for venture, which is okay. I'm going to be here 18, 24 months from now trying to convince some other investor to, put more money in this. Do I believe am I setting myself up to be able to accomplish the things I need to? And will those be compelling enough to allow someone else to actually want to come in and fund this business? And if so, if you can help your venture capitalists understand that in the current round, that helps them think about kind of, managing the risk from downstream financing in a way that can be beneficial to both of you.
So I wonder if you could talk a little bit about career paths, and in particular your career path, and the extent to which it helps to be a founder, to be an operator, and then become a venture capitalist, maybe vice versa. I remember when I came out to Silicon Valley in 1989 or 90, everyone was telling me, "Oh, you should consider being a venture capitalist in tech. It's so awesome." And I kept thinking, "Well, I'm not an engineer. Like I can't do this, right?" Don't you have to be an operator first? Don't you have to go and found a company and then go into this? So you were actually an operator. You worked on Loud Cloud and so forth. And then you also were investment banking before that. Is the career path into venture capital different now? I have a lot of students that come fresh out of school and start working for a venture capitalist.
Yeah, I think it's definitely, it has changed, and I think it will continue to change. And there's really, you're right, there's kind of two ways to think about it. So number one is, I think what's happened is the industry has matured a bit, and therefore, and we've seen this already, look, many of the funds have gotten bigger. And I don't know if I would call them institutional, maybe that's too mature of a word to use, but they have definitely thought about kind of career development in a way that I think historically they didn't, right? So for most of the history of this business, venture capital firms were collections of 3 to 5 general partners, and they might have had an associate or two hanging around and stuff, but there wasn't formalized HR inside these organizations. There wasn't really much in the way of career pathing. You kind of maybe lucked into one of those jobs, and ultimately 10 or 20 years later became a general partner. I think what's happened now is just, look, as with lots of industries, we're now going on 50, 60 years in this business. You get to a maturation point where you need to put those processes in place. And so I think that's why you see kind of what you're talking about now, which is some students, probably more likely able to find jobs coming out of college because we've now figured out what that job is, right? So we think, okay, look, there is a, kind of job for somebody who doesn't have as much experience, but who can help us think about recruiting new relationships on the entrepreneur side, or help us think about, building market maps and stuff like that. And those things just, again, those jobs just didn't exist before. So I think on the one hand, there is probably more democratization in terms of being able to get into this business earlier than there used to be. I would say at the senior levels, though, and this will reflect our own bias, which I fully acknowledge. I still think there is no substitute at some point in time for being part of the startup and company building process. And that doesn't mean that you need to go literally start your own company. But if you think about, again, kind of, I think what makes you successful in this business, as we talked about, it's kind of 3 key things, right? Can you source opportunities? Can you pick the winners? And then ultimately, can you find a way to add value? And I think the picking of companies and ultimately adding value of companies, a lot of that, I think, can derive from experiences of being in a startup and seeing the company building process and talking to customers and going through the product iteration process. And it's not to say that you can't be a successful venture capitalist without those things, but I think if you were writing the script right now and you said, okay, I want to be a general partner at name your firm in the next 10 or 15 years, I think you would probably say building out those second and third categories of skills is probably most well done by having had some company building or operating company experience. So I think that will still be important, and I think you'll still see the majority of people probably go through that. But now that you do have, to your point, kind of firms starting to hire some people out of school, I think it's possible that there could be internal promotion paths that obviate the need for that. But I think we're probably not all the way there yet.
Now, you describe a historical trend that happened. I guess it was right around the time that Andreessen was founded, which is that kind of the barriers to entry in VC were starting to collapse, right? The Y Combinator model, the lean startup model got started, and the cost of starting a company really went down dramatically. How did this impact kind of the bargaining power of the founders vis-a-vis the venture capitalists, the LPs, vis-a-vis the GPs, and so forth?
Yeah, so let's start with kind of VCs and entrepreneurs. It dramatically changed in favor of entrepreneurs, the bargaining power. So again, if you go back to the construct that we had talked about earlier, if you live in a world where capital is scarce and the people who have the capital are basically the venture capitalists, understandably so, the balance of power is going to probably favor more towards venture capitalists, because if I'm an entrepreneur and I'm trying to compete for a constrained set of resources, that puts me naturally at a competitive disadvantage relative to the people who actually own those resources.
And this is why Mark Andreessen wound up with 2% of Netscape after post IPO. I think it was.
I was gonna say I don't remember what the number was, but yeah, I think in the old days, right, in air quotes, right, it was definitely the case that yes, the venture capitalists owned more of the companies, and and I don't mean this in a bad way, but they used their bargaining power to certainly kind of satisfy their economic interests. And then you're right, which is what started to happen in the early 2000s, of course, was the cost of funding these startups started to go down materially, which meant now I could raise $250,000, $500,000 and get something going on a company. Whereas before, again, in the old days, most of what I had to do was raise a bunch of venture capital because I needed to go buy servers and networking devices and all these other things, of course, that we can now rent today. And so that dramatically just changed kind of, number one, the capital requirements for these businesses, and started to flip that paradigm where now the entrepreneurs, capital was no longer the scarce resource, and therefore the entrepreneurs, quite frankly, were interviewing the venture capitalists just as much as the venture capitalists were interviewing the entrepreneurs.
Plus, they presumably demonstrate success much earlier in the process, right?
I think that's exactly right. Yeah. So, because, right, you need less capital, you can run a lot more experiments, you can demonstrate success. You had also the rise of, things like, let's talk about platforms, for example. No matter, we can talk about or avoid the political debate today about platforms, but one of the values of platforms was they really provided kind of sales and marketing opportunities for early stage companies without the requirement that they actually build out initially at least their own sales forces. So you get all this starts to happen, which does make it easier, therefore, for entrepreneurs to raise capital. And then starts to kind of just shift that competitive dynamic. So much more so the competitive dynamic today, favors entrepreneurs. And this is why you see not just changes in term sheets, but also changes in governance structures, right? So, we never used to have boards where the founders of the company controlled more board seats, for example, than did the venture capitalists. And by the way, I'm not making a normative statement here as to whether one is better than the other, but that's a natural reflection of this kind of increasing competitiveness and a resurgence of the entrepreneurs' kind of predominance over the venture capitalists in a way that just didn't exist before. And then, what has happened along with that, of course, is in the LP community, which are the limited partners, right, who provide capital to us, is, we went through a very dark period in venture capital, starting with the .com collapse, in 99 and 2000, where, anytime you looked at the returns of venture capital for a 10-year period, it was just, dismal to look at it, right? The returns were not good. But then what happened again was because of this proliferation of now new entrepreneurs and lower capital requirements to start these businesses, we then kind of, started to see in, 2005, 2006, 2007, obviously, leading up to the global financial crisis, that venture as a, broader kind of asset category was starting to actually show some much more interesting returns. And so what has happened over time is you have increasingly limited partners being willing to now invest greater and greater amounts of capital into venture capital and by the way, into other private assets. And that's another big trend that we could talk about is kind of public versus private assets and where the money's going. And so these things kind of all fuel one another, which is you have limited partners willing to commit capital. Therefore, there is a lot of capital in the market. Therefore, the entrepreneurs continue to kind of be in a position where, they can kind of pick and choose who the partners are that they want to work with. And look, overall, I think that's a good thing. I mean, the downside case of all this would be at some point in time, do we overfund the category? And do we find that the market opportunities are just not as big and exciting as we all thought? And, we all fund, 10 competitors in the same industry that basically just kind of eat each other's lunch instead of kind of creating a winner. But on the other side of that, what we have seen, of course, is the market size opportunity for successful companies is just dramatically different, right? I mean, we you can get to $500 billion outcomes in these companies, which was just inconceivable. Even probably 10 or 15 years ago. If anybody, this whole phrase that everybody's heard about unicorns, right? The reason why that unicorn phrase was so important was nobody had really seen billion-dollar companies with any kind of regularity, right? And so when Aileen Lee coined that phrase, it was an anomaly. Now, I hate to say it, but billion-dollar companies are kind of table stakes at this point in time, right? And so, I think we are in a situation where I think the industry can and will continue to be very, very attractive from a returns perspective. It's very competitive, and that's not going to go away. But I do think we're in a situation where the potential size of the winners is just orders of magnitude when it was before. And so therefore, notwithstanding the amount of capital in the industry, I think for the top players in the industry, this will still be able to produce hopefully very attractive returns.
Well, you mentioned the kind of public versus private, kind of the comparative advantage of public versus private. This is something I talk about a lot in my corporate finance class. And, I think people believe that they understood this until this century when companies remained private for much, much longer. And it seems to people who had never seen this before, it was kind of like the the obstetrician taking care of the person into their 30s. Do you see this trend reversing itself, or do you see this continuing? And what do you think is the main reason for this? Like why we have the Uber and Airbnb stayed private for so long?
Yeah. So I would like to believe this trend will change, and you and I may have talked about this before, and I've kind of spent a decent amount of time in DC with organizations like the SEC and with people on the Hill to try and see if we can address this. I am probably more pessimistic than when I started about kind of this trend reversing, and I think there's a couple of reasons for that. Look, I think essentially what's happened is we've effectively kind of moved appreciation that used to happen in the public markets into the private markets. And I think there were a lot of underlying factors that started with that, probably not the least of which was, companies felt that in an industry like technology where we do have product cycles, that it was hard to be a public company, and that the hard components were partly regulatory, which I'm not that worried about. In other words, it's costly to be a public company. It was hard to go public, and I think the Congress and the SEC have done a very good job of trying to right-size regulatory costs and requirements through the Jobs Act and other things. So I think that's all very positive. What hasn't changed, and which I think is continuing to get more difficult, is what does it look like once you are a public company in terms of how does your stock trade, who's following your stock from a research perspective. And the reason I'm a little bit more pessimistic is I think what's just happened is, mutual funds have gotten bigger, which also means therefore that, they need to trade stocks that are very highly liquid because it's very hard for large mutual funds to trade sub-$1 billion, sub-couple $1 billion stocks just because every time they try to trade them, the stock price moves so much because there's low volume on these things. And so I think some of what's happened structurally in the markets is just that as the financial markets have matured and, assets under management have grown in the broader kind of public market space as well, there's just this natural tendency for people to focus on higher liquidity and therefore what probably means higher value stocks. And there's things I think at the margin we can do, and there still are some policy initiatives that are at play here that might help that. But I do think that's kind of part of the longer term challenge of getting companies to go public earlier. Now, I think the other way to try and approach this problem then is, okay, if we have a situation where it's more intractable to solve having companies go public at an earlier stage, how can we then address the other side of the problem, which is can we make sure that if a bunch of appreciation is happening in the private markets, could more of that appreciation be accessible to a broader, category of people? Because I do believe that, notwithstanding the fact that, look, it's great for venture capitalists and other people to be able to earn a lot of profits in the private market, it's not good for our country to, I think, have more of that appreciation kind of centered on a very small institutional investor universe. So on that side, one of the areas that, I've been talking to policymakers about, and others too, been talking about this, is could we change the definition or liberalize the definition of what we call accredited investors today, which is kind of the, financial requirements and other requirements that are necessary to be able to invest in private securities, and expand that out so that more kind of unaccredited today, so people who have basically less capital resources, would there be a way to allow them to participate in this appreciation in the private markets, hopefully in a way that's safe as opposed to them getting taken advantage of, but trying to recognize that may be an easier part of the problem to solve than it is to try to kind of solve these very deep capital markets structure issues that are encouraging companies to stay private longer.
Well, when I've thought about the relative benefits of public versus private, I always think of kind of the psychological factors. So I teach behavioral finance, and we talk about bubbles and crashes and sentiment and noise traders and how those can kind of gum up the works in public markets. And I kind of always thought that private markets were somewhat insulated from that. I mean, I know that they're coupled because, you go public at some point, and so that works its way back into the private markets. But I always thought that the alignment of interests and the sophistication of the investors would kind of insulate them from a lot of the kind of bubbles that you see in the public markets. But I'm starting to wonder whether that's kind of naive, and whether that I'm underestimating the extent to which these markets function in similar ways, and particularly because the sector's just getting so big, and you're seeing a lot more, I don't know, what you might call dumb money flowing into the sector. Are you concerned that there are some VCs out there that are they're not doing the solid work of value building, and they're just kind of thinking like, hey, can I cycle through this? Can I dump it? Can I, pass the trash, and, I'll be gone, you'll be gone. And, by the time this cycle's over, I'll get my 2 and 20, and who knows what happens after that. Is there a danger that you see some of that happening in the sector as it gets bigger?
Yeah. I mean, I think as the sector gets bigger, there's always going to be, any sector as it grows and matures is always going to attract some element of kind of bad behavior. I'm not overly worried about it in this sector, just because this is such a repeat relationship-based business that, as inefficient in some ways as the private markets are, they are incredibly efficient in terms of transmitting information around who's done, how did people act in a certain way, and who's kind of been short-sighted versus, long-term oriented. And so I think the market has a pretty good self-correcting mechanism to deal with that. I worry more about, let's call it maybe players, I hate to use the word tourist because I think that's kind of, probably a disrespectful way to do it, but people for whom this is not their primary business, and then maybe seeing a short-term opportunity. I think there's more likely opportunity for potential bad behavior there. But if this is your professional career and this is what you do for a living, it's not to say that there may not be bad actors there, but I think it's very hard in a fairly transparent and efficient market to have reputational issues not ultimately kind of cause problems for you, particularly in an environment where, as we talked about, where entrepreneurs have choices as to who they want to work with. And so the feedback loop is pretty tight there. So I worry less about that, and just as I said, more about maybe just potentially people who might not be long-term committed to the asset class. But to be completely blunt, I mean, I think, that exists in every. I think that exists in every kind of bull market, where there just may be people who are believe there is a short-term opportunity to make money, and I don't see that as kind of a predominant part of the market right now.
Yeah, you talk about democratizing venture, and I remember a couple of years ago I was teaching a course on blockchain during the kind of ICO bubble, and there were people talking about, hey, we can just disintermediate these VCs and just go directly to the markets, and forgetting about the legal implications of that, it seemed to me fundamentally misguided, the idea that you could get funding without governance. I think that the kind of the bloom is off the rose there, but do you see any do you see any real challenge or threat from kind of disintermediate? I mean, we see peer-to-peer lending kind of, they never lived up to the promise either. Do you see any threat in that direction?
Yeah, I mean, look, as of now, you're right, which is there will always be, and I think there should be, kind of competing alternatives to venture capital funding, right? You mentioned ICOs. There's been peer-to-peer lending. There's crowdsourcing, which obviously became, as part of the Jobs Act, also came into play. So far, I would say, kind of the early attempts at those have lacked some type of kind of information transparency and or governance to kind of make them, long-term sustainable efforts. Now, I would imagine that, in the version 2.0 of these things, they will get better and better. And I think what that means, again, for us as VCs, it kind of goes back to where we started the conversation, which is, look, if all we're going to be is a source of capital to companies, I think you got to assume, whether it's crowdsourcing or ICOs or whatever, there's always going to be someone out there who's got access to more capital that is at a lower cost of capital than you have. And so if that's what you're hanging your hat on, I think we're all in trouble, quite frankly, and rightly so. We should be, which is, look, if we've got to add some other value. So I think this is all consistent with the direction this industry is moving. Is, at the end of the day, you have to assume that capital is going to be abundant. And you either adjust and figure out some way you add value. And that could be, I'm not saying that our model is the only model out there. There's lots of ways to do it. But I think to assume that basically, capital alone is going to save this industry, I just don't believe that's the case. And so I don't know whether it'll be, newfangled ICOs in a regulatory and legal environment that makes sense. But I think what those markets all missed was a level of transparency of information flow and governance that ultimately, made them accessible to a broader set of folks. But if somebody solves those problems, I think they could be very viable competitors to venture capital.
All right, last question. This book has a lot of law in it, right? You're a lawyer. There's a ton of law in here. You go into the details of term sheets. You really go into all the kind of trade-offs that you have to think about. Incentive misalignments you have to think about. Kind of problems downstream that you might not anticipate. And that's really what lawyers are good at. I used to think that, a business person that didn't know any law is like an architect who didn't know any engineering. How important is it for people to really, if you're a founder, if you're an entrepreneur, if you're an investor, how important is it that you have at least a minimal understanding of the law?
Look, I think it's important. Now, I don't think that necessarily means you have to go to law school, which I did and then decided not to practice as a lawyer. I think there's probably better ways to spend your time and money. But look, I think the way I think about it is, what you learn in law school is you learn how to do what's called issue spotting, right? Which is, kind of all the exams are that way in law school, right? It's okay. Let me just give you a set of facts. And, you kind of figure out what are all the potential issues there. And then, of course, the difference between an A or a B or a C in law school is then the depth of your analysis of those issues, kind of the comprehensiveness of your issue spotting, and then the depth of that. And the way I would think about it as an entrepreneur or a business person generally is you don't need to ever have the depth in any one of those categories. But I do think the idea of being able to say, okay, look, like I have enough of a horizontal understanding of when, I like to think about it this way, which is when am I likely to get myself into trouble and know that I need to pick up the phone and call my lawyer and actually deal with it. So I don't encourage people to, kind of be their own lawyers and do their own research. But, you have way more context on the business than your outside legal counsel will ever have. And issues will get missed if in some cases you don't have some basic foundational understanding that you might be tripping into a territory that you probably don't want to go into. So, maybe the solution is at the risk of self-aggrandizement. Maybe if everybody just reads my book, then that's sufficient. That'll save you 3 years. And I don't know what it costs anymore. $200,000 probably worth of tuition to go to a law school. But I do think you do have to have some basic understanding of it. And look, ultimately, the other reason, in addition to being successful business, is once you're in a company and you're now sitting on the board, right, you have fiduciary responsibilities to the people and the employees and the shareholders in that company. And so if nothing else, just to kind of protect yourself, you want to make sure that you're advised around these issues and have at least a decent horizontal understanding of, again, the places where you're likely to get yourself into trouble.
Well, Scott, you stole my thunder because I was going to say that. I was going to say, save yourself a couple $100,000 and, go get this book. And whether you're a founder.
All right. Well, we're on the same page. I appreciate
investor, aspiring VC. Check out the book. I really recommend it. Secrets of Sandhill Road. Thank you, Scott, for joining me.
This is Unsilo, brought to you by Alumni FM, connecting people through stories.